Simon Property Group is a company that I never really talk about on this channel. They just had earnings and their EPS dropped 10% year over year. But a lot of people have been asking me within our Discord community, which you guys should become a part of. It's completely free. What do I think of Simon Property Groups? So I want to do a deep dive very briefly. I want to kind of go over what the company does, where I think they could be going in the next couple of years. I want to go over some of the key metrics, some of the financials, and ultimately what I would be paying for Simon Property Group if I plan to take a position. The very first thing I want to say is that this is not going to be one of those super cool companies that you invest in that's going to have like major returns over the next 5-10 years. But it could be a company that's pretty damn undervalued. That could be a safe spot to throw your money and in general might make you a sizable return depending upon how conservative you are. So that's what I want to do, because I haven't really broken this thing down in a long time to myself, and I've never done it on camera. So let's get started. For those of you who don't know what Simon Property Groups is, you've probably been in one of their malls before. Basically, they just own the largest real estate for malls and investment trusts, and they manage one of the top retail portfolios in the country. They own a ton of Class A traditional regional malls, different premium outlets, these more high income places that you will see. I know down in Florida and down south, a lot more of them are like those bougie outlets out, like, you know, that are mostly outside. Whereas up around us, it's like King of Prussia Mall, I think is a Simon Property Group, which is like the third biggest mall in the country. So a lot of these are like much higher end malls that have like higher quality property values. And their portfolio is like really dense and really valuable. But basically they've been smashed over the past couple of years, and we've seen a rebound in the stock price, but basically with the Rona, basically with how a lot of people were inside for a very long time, brick and mortar companies were getting smashed. And as a company that mainly owns, like, I think it's probably 90 something percent commercial properties, if not it's 100%, you're going to see things get killed, right? So, they really have not been doing too well over the past year. And like I said before, the stock itself, the movement is going to show you. I mean, Simon Property Groups from February of 2020 to March of 2020 dropped 70% in 2 weeks. Now, since then, the stock did rebound nearly 300% in 1 year and 7 months, but we have fallen back down to this $93 price point. So if you got in down at the 50s, I'm just going to tell you right now, hold that. Like I would hold that for sure. So fair value is at $160 by Morningstar, which is a 32% discount, which is enough to entice me. I really want like a 50% discount, but 30% enough to entice me. Their 5-star price is $112 and we're trading at $108. So really good right now. Now, looking at Simon Property Group, like I said before, these numbers and this growth is probably, I haven't looked at this in a long time. Whenever I shoot these videos, guys, I don't like pre-record or plan on what I'm going to say. Like, I just record and do the analysis as I would do the analysis for myself. But I don't think you're expect massive amounts of growth, but still solid PE right off the board, right? So you see the PE is 15.65. The 5-year PE is 17. Profit margins for the trailing 12 months is 43%, and the 5-year profit margin is 36.8%. That's a solid, I don't want to curse, I don't want to get demonetized, but that's a solid effing business, guys. Really. Price to sales ratio, 6.75. Dividend is 8%. Enticing. Very enticing. Most of the time, I don't care about a dividend, but an 8% dividend is pretty damn solid. I mean, let's just even look very briefly at the price of the stock. Let's say that you bought in this time last year. So let's just say you bought in even January of 2021, right? The stock is flat, actually up 8%, but you would have made an 8% dividend, so you'd be up 16%. And let's say that even you bought at the worst time, which was November of 2021, and the stock is currently down 36%, which sucks, you'd still only be down about 28%. So a really good dividend. Which is not something I care too much about, but 8% is pretty solid for a couple of reasons. If they're paying an 8% dividend, number one, that you're basically beating the market right there. As long as your common shares don't drop over the year, you're basically beating or hitting the expectations of the market. The number two thing and the biggest thing is that if crap goes sideways in a recession or just in general, they can cut that dividend in half. They can cut it a bit. They can just cut it entirely, which a lot of people would freak out at. But if I'm looking long term, 10, 15, 20 years, I like that because they have enough cash to be giving us back. I want them, if they have to cut that, to go ahead and do that. Looking at the income statement, like I said, this income statement is not going to look too beautiful, but it's really whatever. Operating revenue, you can see here, 2018, and this is a bit of an issue. It's one thing I do want to state here. So let's look at the past 10 years. Normally, I'm only looking at 5 because 10 years is great, but I'm really looking at 5. The issue with this is that 2020, 2021, 2022, like things are, those numbers are hard to look at. Not necessarily because they're bad, but it's just hard to look at because I want to see how the company was performing before we had this shift that we've had for a while. So if you look at 2013, 3.8 billion, 2014, 3.6 billion, 2015, 3.35 billion. So, you know, even way before the Rona, growth was declining. Operating revenue was declining, which is something just to note. And like I said, I'm obviously expecting that. Now, if we look at 2017, we had 3.69, 2018, 5.62, 2019, 5.29, 2020, 5.34, 2021, 4.2, and now we're bringing our way back up towards that 5 billion. So not a growing company, right? I know that most people are going to want to invest in a growing company, especially if you're watching my YouTube channel. My analytics is like 95% men from the ages 18 to 35. It's probably not a stock that you're like going to be interested in or looking because it's not growing as fast as, you know, a lot of these bigger companies like Tesla or AMD or any of these things, but it's very attractive for the value that it's at right now. You're not going to see PEs for those fast growing companies that are like under 25. So let's go through and look at net income because net income is very important. So if we look at our net income in, I don't know why this software does this. I use this for highlighting and it just makes it really big. But let's go look at 2018, 19, 20, 21, and 22. So they were netting 2 billion in 2018, 2.3 billion in 2019. So that's one good thing to realize. 2018 to 2019, they weren't growing on a top level for revenue, but they were still keeping an extra, you know, $300 million, which is good. So they're netting more money. But then 2020, it goes back down to 2 billion, 2021, 1.1 billion, and then 2022 is 2.3. We're popping back up. So even at the worst, right? Even at the worst, they weren't losing money. Net income for 2021 was still green, which is very good. So let's go back up. Let's take a look at the balance sheet because this is something that's important. I want to see how much debt this company has. And this is actually like the worst thing that I can actually not think of. It's not really that bad, but it's still not what I like. So total assets, let's look at the past 3 years. Total assets right now is 33.45 billion. Total liabilities is 29 billion. So even before the pandemic, they had a lot of debt. Now, of course, it's a real estate company, so they're going to have a lot of debt, but they have enough cash right now that if they wanted to pay all the liabilities off and basically have nothing, they could. I really like to see 2-to-1 or 3-to-1, but I don't know the intricacies of the company enough to know if like how much debt is on the properties, etc., etc. It's going to have a lot of debt because it's a real estate company. But for me, that's like one thing I wish that there was a little less debt and, you know, the liabilities, debt to liability was a little bit better. But still not bad. I'm sure they can still pay everything off by writing a single freaking check, which is a good sign. 5-year PE 17.8, very solid. 5-year revenue growth, the company's not growing, right? They've actually lost $400 million. So the company's not growing. Net income growth is growing. That's good. Shares outstanding 5%. They did do a bit of a dilution, but it's nothing insane, right? It's not like it's 30% or 20%. That's how a company raises money. So I'm not really worried about that. Now let's go through, analyze what would be a good price to buy. So the past 10 years, average revenue growth is 0.5%. Past 5 years, average revenue growth is 2%, or a loss of 2%. Past 1 year is 15%. So for revenue growth, I'm going to say on the low side, 0.5. Well, 0.5%. Maybe let's just say 0%. Let's just look at worst case scenario. Mild would be 2%, high I think is 5%. You can't take that 15% that we just saw, because that's not a clear cut number. So profit margins past 10 years is 33%. Even though the company's not growing, their margins are solid. So let's say 30%, 35%, 40%. Free cash flow, let's say 45%, 50%, 55%. PE, let's go with 15, 20, 25. I don't think the PE is going to get to 25. Let's do 15, 17, 20. That's more conservative. I'd always rather be more conservative, guys, than to end up being more aggressive. Let's run these numbers. So, in order to be purchasing the company, if you believe all of this can happen, the high side of things, right? 90% or $90. If you think all that happens, $90 is a good price. If you think the middle happens, which I think can definitely happen, $58. So you can see it's nowhere near what I would actually want to pay for it right now. It's nowhere near that. We're trading at $106. Now, what I like to do with this software, the company's called Everything Money. That's what the software is on. I have no affiliation to them. I don't really watch. I know they have a YouTube channel. I don't really watch the YouTube channel, but I do really like this specific stock analyzer for these videos. The company has to figure out a way to grow, because margins are already freaking high. So they have to figure out a way to grow. If we were to change the revenue growth number here on the best case scenario to 10, and then we were to change it to 5, and we're going to change this to 3, and we reanalyze everything with the same margins, you can see that $90 goes to $130. I don't see them growing at 10% revenue on average for the next 10 years. So for me, I'm sitting this out. However, when it was down at 42, that's perfect. If we can get back down to 42, I will reanalyze this. I will potentially take a position, but at this point, it's something I'm sitting out on. Thanks for the support, guys. Have a good day. Peace.